In this video, we are going to do an introduction about investing in stocks. This is just an introduction. A lot more to learn about stocks before actually engaging. Why investors purchase common stock? Investors want the larger returns that stocks offer. So from the general standard menu of investment options, bonds, CDs, money market, gold, real estate, stocks on average will offer larger returns, but they do come with higher risk. And that's what it says there, even though they are aware of the potential for losses. How do you make money by buying common stock? There's several ways. Income from dividends. If the company pays dividends, then you get a cash payment. You may get additional stock from the company. Sometimes instead of actually giving you a cash dividend, they just issue more stock and give it to you. Or company products. That is newer. Well, relatively speaking, is newer, where people can invest in a company. You see it online on those crowdfunding, etc., where what they do is, instead of giving you stock in the company, you get to pre-order, for example, or you get some perks and benefits. Dollar appreciation of stock value. So in this case, it's not dividends or anything else you got. On the side, the stock price goes up. You made that money if you sold the stock. You gained. Possible increased value from stock splits. Stock split happens when the shares owned by existing stockholders are divided into a larger number of shares. Now, the math, if there's no change in value in the company, a stock split it will leave you with more shares, but the price will go down to half. Let's say, for example, they split it 1-for-1 or in half. So technically speaking, if the value of the company doesn't change, the stock split just gives you more shares, but your total is still the same money-wise. However, what happens is that for a variety of reasons, when there's a stock distribution, which is just a formal way to call a stock split, the value does go up and you end up with a larger total amount of dollars. Preferred stock, this is a different class of stock. Investors in preferred stock receive cash dividends before common stockholders. Called preferred because of that. It typically comes with a guaranteed dividend. Let me not use the word guaranteed. With a fixed dividend, a periodic dividend. Now, the reason I say it's not guaranteed is because if for any reason the company has a cash flow problem, they can omit that dividend. What they do guarantee is that if there's money to pay dividends, the preferred stock people get it first to what they were promised. If there's cash left, then the common stockholders may get their cash dividends. So it's considered a middle investment between stocks and bonds because they do have certain qualities that look the same as in the fixed payment, periodic, and that they get it before common shareholders. However, just so you know, interest payments towards bonds are the priority, then the preferred stock, then common stock. And yes, the dollar amount of the dividend is known before the stock is purchased, unlike common stock is whatever they can declare at the time. So that's another way to say, if they're going to pay the dividend, the amount is guaranteed, but the dividend itself being paid is not guaranteed. Preferred stock dividends are less secure than interest on corporate bonds. Going back to what I just said, the interest payments come first. Compared to common stock, preferred stocks are safer investment that offer more secure dividends. Now, because of that, you would expect the return on your investment of preferred stock to be lower because there's less risk. Evaluating a stock issue. Okay, so there are different classification of stock investments. Now, first, to know this, if a stock is in one of these classifications, it doesn't mean it's always there. Depending on the situation of the company, they might jump in and out. And it's just if the valuation of the company, the evaluation of the company changes the situation. Blue chip is considered fairly safe stocks. You got cyclical, that just means stocks that have like seasonal effect or the business cycle, etc. Defensive, that's Utilities, because they're pretty safe, steady. So even in recession times, the return pretty much stays the same. Growth, we have spoken about this in previous lectures. These are stocks that may not generate dividends or income, but because of that, then they grow faster. That's one of the reasons. Other ones, this could be like a young company that is going through a super growth phase, things of that nature. Income, these are the ones that are more like dividend payments, bonds with interest payments, preferred stock. These are more to that you actually get cash periodically. Large cap just means a company after a certain amount of money. Of course, as time goes by, to be considered large cap, the minimum keeps on going up. Just standard regular inflation happens. But it just means the larger companies, when you look at the price times the shares outstanding, the value of the company. Mid cap, just like it sounds like, that's the next level down. And then small cap, those are your smaller businesses. Micro cap, even smaller than small cap. And then you got the penny stock. Penny stock is a nickname and typically very high risk, high reward. So, but very high risk. I'll repeat that. Now, it doesn't mean that you may have companies that fall in more than one of these. You can be blue chip in income, most blue chip will be large cap, and so forth. You can be cyclical and small cap, etc. Stock advisory services provide both printed and online materials to evaluate potential stock investments. Is a charge a fee. Now, with technology, there's a lot of material you'll get free online when you open an account anywhere. But if you need advice above and beyond of what's available on their websites, then there's going to be some fees associated with that. Now, if you go into specific companies that are not a brokerage company, but what they focus on, what they specialize in evaluating investments, these are like the Standard & Poor's, Value Line, Morningstar, those charge a fee, but you get more in-depth detail. A lot of companies pay for these to get their reports and analysis. As an investor, your job is to interpret the information provided and decide whether the company stock is a good investment. At the end of the day, the analyst, advisors, everybody can tell you their opinion. You still have to make the choice. They cannot guarantee that their opinion is going to be what actually happens. Newspaper coverage and corporate news. The federal government requires corporations selling new issues of securities to disclose information to the public in a prospectus. The way they disclose information to the public, it gets posted on websites, it gets reported on the news channels. Of course, the news don't cover every company; they can only cover the big ones and the ones that are of interest to the majority of the public. But yes, they gotta put it out there. Information must be periodically reported to the SEC. This information can be viewed at their website. So yes, there is a SEC website. You can go in there and check their, what they call the 10 case, just annual reports, quarterly reports, changes, and things like that are material. Now, understand this, when you go to the SEC, that's going to be the minimum information required by the government and the regulation. So all you're going to get there is the minimum. These other ones that we speak of, they are going to have a lot more information available. So there's a good starting point, but it's very bare bones information. Use an annual report to learn about the company management. The annual report not only reports the financials and all that, but there's a lot of information on their future plans, what the management is trying to do, how they're correcting if bad things happen, and how they're making the company better and adding value for the future. Learn about goals and past performance. So they will have historical financial statements on the reports as well. Numerical measures that influence investment decisions. Now, there's a lot of them. We're just going to talk about a couple of them so you get an idea, and some of the popular ones. Corporate earnings are important. At the end of the day, if you're not in the speculation game, the company has to be earning. The more it earns, the more value it has, then the stock price goes up. That's the idea. So corporate earnings play a large part in the increase and decrease in the price of a stock. Yes, but the reason to say it plays a large part is because then there's there other parts of this, other two big parts of this, but the next big part is the future expectations. If there's expectations that company is gonna do a certain amount of money or good or not, that's going to be priced in the stock price today, those expectations. And what happens is as time goes by and the actual earnings start showing up, then the price gets adjusted. If they perform better than expected, you expect the price to even go higher. If they did exactly as expected, the price will hold the same. If they did less, then you expect the price to go down. And that's how that keeps on happening. The other piece is behavioral finance, which is just market activity that has nothing to do with the company. And it's just people's beliefs, fears, greed, etc. Or just trade transactions that happen for whatever reason. Let's say all of a sudden a lot of people need to liquidate assets because they need the cash. Then that has nothing to do with the future performance of the company. It just means that people need to liquidate. So a lot of selling happens and your price drop, but those will be temporarily. Earnings per share. In a nutshell, all it means you take the net income and you divide it by shares outstanding. So they're just breaking down a dollar amount that is per share of the net income instead of the net income as a whole. So are the corporations after tax income, net income, divided by the number of shares outstanding of common stock. An increase in earnings is generally a healthy sign. It says generally. We're not going to get into the details. However, there are some manipulations that management sometimes does that gives you some apparent higher earnings now, but then there are big crashes in the near future. So you also have to pay attention to that the earnings, the increase in earnings are just better efficiency of the company, more market share, combination of both, etc., and not necessarily just some kind of a numerical manipulation or management manipulation where you collect short-term earnings and sacrificing long-term earnings. That's for more your accounting classes or the finance classes. Price earnings, the PE ratio, is the price per share divided by the earnings per share. So now that we know what the earnings per share is, what you do is then you look at how much is the stock being sold on the market. And then you divide that by that earnings per share that was just spoken about. And that gives you an idea of the price people are willing to pay. It's like a ratio versus the earnings the company is getting per share. And that tells you a lot about the expectations. A high PE ratio means that people have a lot of good expectations of the company if it's properly priced. One thing to be careful with is that it could be just a hype. And for some reason, people just felt that it was cool to buy the stock, and if they're overpaying for the stock is what I'm trying to get to. If they're overpaying for the stock, you can have a high PE ratio, and it doesn't necessarily mean that there's good expectations of the company in the future. It just means misguided behavior in the market. Because if that's the case, then expect the price of the stock to drop. Investment theories. Okay, so there is a lot of different ways to evaluate and analyze a firm in order to decide if the stock is at a good price or not. We have fundamental analysis based on the assumption that a stock's intrinsic or real value is determined by the company's future earnings. Earlier mentioned that a piece of the price of a stock in the market includes the expectations in the future. So fundamental analysis considers expected earnings, expected financial strength of the company. Are there very high risk, too much debt? You do want some debt, but too much debt could be a problem. Type of industry companies in, is it a high risk industry? Pharmaceuticals is typically considered in the higher risk end because a lot of money goes in research and development, but it's no guarantee that you're going to get the next big drug. But when they do get it, it pays off a lot. New product development, they're stagnant or they're moving towards the future. Economic growth of the overall economy. Let's go back to new product development because I immediately thought of Apple. Apple as a company, and all of a sudden, the news is out that they don't have anything new coming out in the near future. That could be very devastating for Apple. They are the leaders or one of the leaders in new technology coming out. Back to economic growth of the overall economy. So also external influences that are not necessarily directly related to the company itself, and it's just the economy as a whole. Are we going to go into recessions or not? Booms, are they going to be normal? Those things matter. Some more investment theories, the technical analysis. Based on the assumption that a stock market's value is determined by the forces supply and demand in the stock market as a whole. In a nutshell, what it's saying is that you don't need necessarily all that information about earnings, future expectations, etc. They're saying that the market, the price goes up and down based on supply and demand, and that's all the information required to be able to do some predictions. So in other words, what they're saying is if you look at the historical movements, recent, you don't have to go like 10 years back. You could, but what was happening 10 years ago may not have a lot of influence on what's happening now. So let's say you go several months back or even a couple of years back and look at the trend, and you take the averages and of your standard deviations and your volatility and your price, and then you just do a projection of where the price is going to go. It follows. Now, that can be useful, but that's assuming, and this is a big assumption, that everything is going to continue the same. There's no, the economy is going to follow the same patterns, the same cycles, which is outside the company, and the company is going to continue at the same level. But the reality is that anything fundamental changes, let's say a new competitors enter the market, that's something that was not happening the last 2 years, is going to have an impact. Economies move, recession, boom, normal, unexpected things, changes in interest rates by the Fed. That's the reality. So technical analysis works as long as everything else stays the same. But the second a fundamental change happens, which is the ones example, like I said, if competition enters, your market share is going to be fractured and fragmented. So technical analysis, be careful. It's very popular, very common. The people that really dedicate to this, they do a combination of technical analysis and fundamental analysis. Not based on expected earnings. There you go. It's no future is looked at, is pretty much all based on the historical items, but rather on the assumption that past market trends can predict the future direction for the market as a whole. Again, that's just assuming that it will continue operating the same and nothing's going to change. I'll use a pandemic, for example. Pandemics don't happen very often. So that would be a change where your technical analysis will fail. Charts plot past price movements and other market averages to observe trends they use to predict a stock future value. So it's about trends. Some more theories related with investments, the efficient market hypothesis. This is a very popular hypothesis. It can be very lengthy to go into discussion, but here we're just going to give you the quick overview based on the assumption that stock price movements are purely random. So it's saying that trend that they talk about, let's say you do technical analysis and you follow trend, you may be able to predict with certain level of accuracy, assuming there's no big fundamental changes, where the stock price is going to be in, let's say, a year from now. What you cannot predict is how it's going to get there, which ups and downs is going to have. And that's random. We call that random walk. A stock's current market price reflects its true value. That means that the market is efficient. And that's what's called efficient market hypothesis, meaning that while it may go up and down, some fluctuations on a daily basis, it's going to average out really fast to the actual value of the stock, meaning that price on average, it's the actual value. You will have deviations, you have some ups and downs. That's a random part, but on average, it will always reflect the actual value. It is impossible for an investor to outperform the average for the stock market as a whole over a long period of time unless they pick riskier investments. This is the typical thing about the beating the market. And not to get into many details, but you see all the time people try to sell a book or in a video, they talk about how you're going to beat the market. Now, just like winning the lottery, it may happen from time to time, but nobody can consistently beat the market in a long period of time unless they pick riskier investments. So they may beat the market return-wise, but not on a risk-adjusted return comparison. So what they're saying is that then you are in a world where you're taking too much risk for what you're actually getting out of it. And it's not considered worth it. It's not efficient. Buying and selling stocks. Let's talk about primary market and secondary market. This is what's happening. Primary market, there's some descriptions there, but here's the quick definition. If the investor purchases the stock coming from the company, where the cash from the investor goes into the company, there might be middle people, intermediaries, brokerage, investment banks, and all that. But the point is that when the investor buys the stock, the cash makes it into the company. That's primary market. What mostly happens out there when you go online and do some stock trading on your platform, you're buying it from somebody else, not the company. And that's secondary market. So that cash transaction is only exchanged between the two investors, and the company does not see that cash. So that will be secondary market. So primary market is when the cash from the investor does go into the company, even if there's middlemen in between. And then secondary market is when investors sell and buy stocks between themselves, which that cash just gets exchanged between the investors. It does not go to the company. Here they're talking about the secondary market, which I already explained between these two slides, primary, secondary market. For our secondary market, there are some differences out there between New York Stock Exchange and NASDAQ. Your average investor really doesn't get impacted by these differences between New York Stock Exchange, NASDAQ, et cetera. As a matter of fact, when you go on your trading platform, or people that go on trading platform and they trade stocks, they pay little attention to whether it's NASDAQ or New York Stock Exchange or one of the other ones. But for those that go into the professional side of this, it's important to know the differences and how they operate. Brokerage firms. Service discount firms. You get the full service, the discount ones, and the online brokerage firms. Online brokerage probably being, while they could provide you full services there through the online brokerage firm, but mostly it's just self-managed, which it just becomes then a discount, another form of a discount firm. So questions to find out is, can you buy or sell stocks online or over the phone? Many companies do both, but what happens is that if you do it over the phone, then they charge a fee versus you go clicking on it online. How easy is it to use the firm's website, and what services are available online? This is true. Not all websites are the same. Some of the big companies like Charles Schwab and Goldman Sachs, et cetera, they have brokerage accounts, and they're going to have all kinds of bells and whistles and features, and they do that to attract more people to use their services. But not all big companies are going to have all those bells and whistles, because some other ones are more geared towards your plain vanilla type investments, what they call boring, but it's just like your steady standard portfolios. or they dedicate to institutional investors, which are the really, really big investment companies. So they come in a lot of different flavors is the message. You just got to find the one that suits your needs. Where is the nearest office located? It really depends on your needs on that. If you have the need of knowing that there's a physical location you can visit and it's important to you, then you want to know about that. A lot of people just use the online services to the max and then just whatever customer service they can get out of that for a remote company. Is there a charge for statements, research reports, and other financial reports? What you may find in this day and age, because a lot of competition, is that you got certain level of things that are free. Let's talk about research reports, for example. But they're going to be not generic. They're going to have good information, but they're just some information. And if you need something more in depth, a lot more detail and more specifics, then those may have fees associated with them. And then what are the fees, charges, and commissions? Lately, with all the competition out there, fees, charges, and commissions have been going down and down up to free trading, etc. So they're still there. There's still some there, but more and more services are being offered for free because the competition has driven that. Completing stock transactions. Okay, these are the three basic transactions. However, if you ever open a brokerage account and start exploring, you'll see that there's a lot of combination of transactions and other names out there. But these are the three basic ones. Market order. That is, you say, I want to buy or sell the stock right now at the market price. And then that's it. It just gets posted. If you buy it, as long as somebody's selling it, you can buy it for whatever price is showing on the ticker. Same if you're selling it. Limit order. Request to buy or sell a stock at the specified price or better. Okay, so if you're buying the stock, you can say, let's say the stock is like at $50 right now, but you think it's a little overpriced. And so you just put a limit order saying, now this if you're buying it, said, I will buy it if it drops to 49. So what it would do is, in so many shares, you have to specify the amount of shares you want. What it will do is, as long as it stays above 49, and this is automatic, you don't got to pay attention. You don't got to monitor it. As long as it stays above 49, it's not going to buy the stock. But the second it has 49 or lower, it will start buying the stock for the amount of shares you want. And by price or better, it means that if it dropped to 48, it will buy it at 48. So you don't have to worry like, oh, but I put the order at 49 and if they drop to 48 and they bought it at 49. No, I mean, of course, it'll start dropping 49, blah, blah, but as soon as it hits 49 or less, it will buy it for the lowest price. Selling is the same, but the opposite, because you want to sell it for the highest price possible. So let's say the stock is at 50 and you own it and you want to sell it for 52 or higher, then you do that a limit order. So what it'll do is, as long as the price below 52, it will not sell it. But once it reaches 52 or higher, it will sell it for the 52 or the higher price. So you will get the most money. So in the buy side, you'll buy for the cheapest possible, as long as it meets your criteria. And if it's on the sell side, it will sell it for the highest possible, as long as it meets your criteria, the minimum you want to sell. Stop loss order. Request to sell a stock at the next available opportunity after its market price reaches a specified amount. Okay, so let's say you own a stock and you bought it for 50. And let's say it went up to 53 or so on. But then all of a sudden, the stock price starts going down. Now, you don't necessarily want to sell it because it could be just a small downturn, but you're worried that it may actually have a big, huge downturn and you don't want to deal with it if it goes below a certain price. So what it does is, if the stock, you pick the number you're comfortable with. And what you're telling it is, if the stock price drops below this number, sell it. And that way, sure, I might take a loss or just a small gain, because it doesn't have to be that way. But the point is that you prevented a larger loss if it started going really, really down. And that's the idea. Long-term investment strategies. Buy and hold, just what it sounds like. You buy it and you hold it. You're patient. You wait for the downturns in order to enjoy the upswings. dollar cost averaging. This has to do with, instead of just being very picky about when to buy or sell a stock, you can just do periodic purchases. Just as an example, it could be weekly, could be daily, it could be monthly, doesn't matter. Let's say monthly. So every month I'm going to buy $100 of that stock, 200, whatever, pick a number. The point is that, and you don't have to pay attention of the ups and downs. The point is that, sure, sometimes you may buy it when it's at a higher price. So you're going to have to wait for those to continue growing to get the capital gains. But at the same time, because it's periodic and the randomness of it, you're going to be buying it when it's below a certain price or lower. So what happens is then when you calculate the average price you pay on the highs and the lows, the actual average versus the growth of the stock will average out to the same percentage growth you would have done anyways. Direct investment and dividend reinvestment plans. Okay, so direct investment and dividend reinvestment plans. Let's explain that dividend reinvestment plans. What happens is, if stocks pay dividends, you can keep the cash, or you can select an option where automatically use the dividends and purchase more stock with that money. Now, your tax implications will vary because dividends will still be considered as income, but instead of you just collecting the cash and sitting there, it automatically buys more stock. And that way you can continue that steady buying of stocks. Short-term techniques, you have heard of day trading, and just what it sounds like, you take some positions at the beginning of the day, and if you're doing proper day trading, you get out of these positions towards the end of the day or before, regardless whether you made money or not. That would be the actual definition of day trading. Anything after that, you're doing swing trading, period trading, or buy and hold. Buying stock on margin, that's just a vocabulary term that we use when you borrow money to buy stock. Now, there's a lot more to that. You got to have some value in the account, and they'll lend you some percentage based on what you already have in the account. And what happens is, if money's being lost, like the value is going down because the stock price is going down, they may do a margin call. That just means they call you, so like either put more cash in the account to cover those potential losses, or they have the right to automatically start selling some of your stocks in order to balance that out. Selling short, it says borrowing stock. Yes, the process is borrowing stock, but this is how it works. First, understand, when you short a stock, you make money when the price goes down. So your standard buying a stock and selling a stock, let's go back for a moment. It's when you buy a stock for, let's say, $50, you wait, it goes up to 55, and then you sell it. You made $5. So you buy low, sell when it's high. Shorting stock, it just flips that order. You're going to sell high first and then buy it when it's low. So this is how it works. You think a stock is going to go drop in price in the near future. So what you do is you borrow the stock to sell it right now for the current price, that is, let's say, $50. And you think it's going to go down to 45 or whatever number, as long as it's lower in the future. So you're not buying the stock right now. You're going to buy it later when it's cheaper. But in order to sell it to somebody now for the higher price, you need to borrow it from somebody. So you borrow the stock, sell it for the $50 now that people are willing to pay for it. And if you're right, the price will go down at 45, let's say. And then what you do is you buy it now for 45. So it's the same buy low, sell high, but in reverse order. You sold it first, then you bought it. Now, the thing is that if you're wrong, you're still going to have to buy it in the future. And if it went up, you got to pay the higher price, so you lose the money because you ended up buying high and selling low. Trading in options, predetermined price. Options, this is a more complex strategy. Just to, in a nutshell, what it is, an option, just what it sounds like, it's an option to buy the stock. You're not actually buying it. So what you do is you pay a few dollars to hold a stock at a certain price. You haven't bought the stock. You just paid the rights to that stock at that price. And then what happens is, it depends on the side you're on, but let's go with standard. If that stock price goes up, then you go and execute your option and you make the difference in price because you had the option to buy it at a certain price. Price went up, so you still get to buy it for the lower price, and now you get to sell it for that higher price. But if it doesn't work out, the price didn't go up, you just don't have to buy it. But you paid that fee you paid to have that right, that choice. That money's gone. But that's just like a fee you pay in order to have that choice, that option. It gets more complex than that, but that's the gist of it. We'll stop this video here. See you on the next one.